Well, hi everyone, and welcome to the Buffett and Beyond Saturday Stock Market Recap. And here it is, the end of May already, May 31st, 2025. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And, well, this week, the market, we had a really good May, but is May just a bounce back from a dismal April? Yeah, I think it was. And guess what? Over the past 3 months, the overall market has really gone nowhere, and we're going to look at a chart and see that exactly. And we're very happy our portfolios are having a nice normal year while the market is really doing nothing for this entire year. In fact, is down just a tad for the whole first 5 months of this year. And our weekly stock analysis, well, we go over Meta and it's been doing just fine, thank you. We have projections for 2026 which are telling us that with 3.7 billion monthly users, advertising revenue is increasing nicely for this great company. And our ETF video, well, let's show you how we use our computer program to find those great stocks. Let's go live to the program and go step by step because we're going to look at 2 semiconductor ETFs and look at that one good stock that's in only one of those ETFs. And yes, it's Taiwan Semiconductor. And should it be in our portfolio of top stocks from the semiconductor sector? And that's the one key here, folks. And we're going to show a chart, and you're going to love this. All right, let's look at the market this week, and here we are. Gee, we've done nothing. We've done absolutely nothing. Now, this is 3 months, so this is May in here. This is April, and here we have March. And if we look at the beginning of March, we can see, oh my gosh, we're just not quite there yet. So we haven't done anything in the past 3 months except go down, and here's that terrible April in here, and go back up, and here's that nice May. So we have to see where we're going, but you can see right now we are testing this 20-day moving average. And these bands up here, the 2 red lines, they're called volatility bands, and these particular bands are named after John Bollinger. Reason is because he came up with these volatility bands which move relative to the market. And by that I mean these lines are 2 standard deviations away from the 20-day moving average. And that means as the prices change, these bands will change. So the bands tell us what the market's doing. And right now they're saying, I'm not excited. But when we come down here, this is our intermediate term indicator, and we're in overbought territory, which we can stay there for a long time. But it looks like this blue line is starting to cross down below that red line, and that's not a good sign. So we have to be a little bit careful going into the summer months. And our stocks are doing just fine, but the general market is just kind of treading water to see what happens with all this tariff information that we're getting on an hourly basis. And let us look at a 6-month chart of the S&P 500, and these are the candlesticks, and we can see up here that, yeah, we may be approaching this previous high over here, but we are still a ways from the all-time highs back here at the end of February. So February was our high in the market all the way over here, and then we had that big decline going into April, and now we have come back, but we are stalling out right here. And this indicator up here is the stochastics indicator. Remember what stochastics is? It measures where the market closes during the market travel of any particular day. Now, what this means is that we look at the travel of the market for the day. We could take any line in here. Let's look at this one because it's nice and big. And did the market close midway through the market travel of the day, or near the top or near the bottom? And we can see, if we look really close, that it closed near the top. So that gives us a positive movement on this indicator up here. And that's what stochastic means. Is the market closing in the top half or the bottom half of the day's travel? That's all it means. And people are nice enough to put this on a computer program so we don't have to figure it out. But point I'm bringing out here is that we almost reached the previous high of just a couple of weeks ago, and this indicator reached a much lower high. So that has us a little bit worried. And you can see, well, we had this double top in here. And anytime we have a double top like this, we start to worry about the market. And that's why we're selling calls in those portfolios for the people who want to be able to pay for their put options. So we've been selling some calls on some of our stocks, and that's bringing in nice money so we can pay for those put protection options. So yes, we're protected about 12% below the market. And what that means is that the daily movements do not bother us so much, but if we get a big decline like back in here, then those put options come into play. And when the market drops 10 to 12%, we don't care because we're pretty much fully protected after that particular point. And when we get topping action like we're seeing here and slightward downward movement or getting ready for maybe a downward move heading into the beginning of June, then we might get some downward movement in the market, because look what we have here. We have the 200-day moving average, which is this red line, 20-day moving average, which we saw in the last chart, which happens to be this green line. And if you're wondering, this blue line is the 50-day moving average. So we're coming down to test this area again. And I have no doubt that next week we will. The key is, will it hold? Will this area become a line of support, or will it become a line of resistance with the market falling through it? Then we'll have to go back up and test it, and then we'll see if we go down to this 50-day moving average. But what we don't like is, with the market being down on Friday, we had heavy volume. See this vertical red line down here? That's the volume on any particular day. Red means the volume and the market turned down. Green means the volume when the market was up for the day. And you can see back in here, the upward volume started to dry up, and then we got a lot of negatives in here. So we still have to worry about this market. And remember, we're overbought in here, so the market is definitely taking a rest, and it's going to test this area next week. So we'll see what happens as the test is true, or does it fail? And only time will tell, folks. But meanwhile, we're in good stocks, and some of our stocks today really popped up all of a sudden. So we had a positive day in our portfolios while the market had a slightly downward day. So we'll just have to wait next week and see what happens. And portfolio protection. You remember that when we were going down, we put spreads on so we can get some money out of these spreads, or out of these puts, so that they didn't cost us any money. And actually, they only cost us a couple of $100. So we took that part of the spread out, because this looks a little different than it did last week. We had a put spread in here, and we took those spreads out in the daily letter and kept the full protection there. And probably this week we just might roll over this June into September already, just because we're near the top and we want to be able to buy the September puts at a very inexpensive price. And right now the SPY is at 589, and remember, the SPY is 1/10 of the S&P 500, and the S&P 500 is represented by the SPX, and you can see why they got SPY in it, 1/10 of the S&P 500, and we are within 4 points of where we were last week. So we really haven't moved, folks, at all. But we have this protection, which is now about 11% below the present area, or the present level of the market. So the market falls 20%, we're protected after 11%. And don't forget, the reason we use puts is because as the market goes down, these puts become more valuable. So it's not like you're putting a stop in the market, which can be taken out in a heartbeat. It's not like putting a stop in the market or buying an inverse ETF, which goes down, which goes up as the market goes down. But these puts can remain in place, and they go up as the market goes down. So really, we start being protected as soon as the market goes down. Not fully protected, but when it goes down, right now at 11%, any more than 11%, we're pretty much fully protected if the portfolio follows the S&P 500. So that's the key there, is that we can't say we're fully protected because our portfolios might not move in concert with the averages, with the S&P 500 to be exact. And so therefore we are partially protected, mostly protected, I should say. So we do have protection on, and you don't have to worry about these daily fluctuations or what's going on between China and the U.S., except if you're watching the news, or you can go fishing or go to the beach. So don't worry about it, folks. If you have this protection, you're just fine. So, folks, we had a pretty much do-nothing week. We had a pretty much do-nothing 2 weeks. And for the for the past 3 months of this year, we have gone absolutely no place, and we are sitting below the highs of the year. So therefore, we just have to wait to see what happens this week, because we're going to hit support, and we want to make sure that those lines of support really hold. So, folks, you take it easy this weekend. Forget about the market. We'll be back with you in a few days. So, most of all, stay safe, be with your family, be with your loved ones, and just take it easy for the whole weekend.